So again, I'm going to use the Costco as is, and I'm going to save this as the Nordstrom, ticker symbol JWN, and I'm going to call this the baseline. And I'll put this in the new folder, JWN, put it in the Nordstrom folder. All right, and then, so what we're going to need to do is in the Nordstrom files, we're going to have to download these files. So we're going to need the balance sheet, the income statement, and the statement of cash flow. So here's the balance sheet, here's the cash flow, here's the income statement. So I'm going to use the same files that you're using. And those should all be in my downloads folder here. All right. So first, I'm going to start out with the model that we were using in Excel. So if you remember when we talked about the model, I said the first three tabs, income statement, balance sheet, cash flow, came from Bloomberg. So basically, to get these, if we went back to Bloomberg, if I went to the FA screen, which stands for Financial Analysis, under the income statement, we exported the standardized income statement, so output to Excel. We exported the standardized balance sheet, output to Excel, and the standardized cash flow, output to Excel. Right? That is what is in these three files for Costco, and the exported data for Nordstrom is in that downloads folder. So here's what I'm going to do. I'm going to take the exported data for Nordstrom's, the JWN income statement. I'm going to select the whole thing. I'm going to copy it. I'm going to go to the previous Costco model in the Data IS tab. I'm going to select the whole tab, and I'm going to paste special values. So I'm pretty much going to overwrite what was in that tab for Costco with the Nordstrom data, cell for cell. Now it's very important that I overwrite it completely so that our model is relying on the fact that revenue is in row 14. So for some reason, revenue is not in row 14. When I copy and paste it in, it's going to cause problems. So I have to make sure that I put it in exactly that standardized format. Right? So the easiest way to do it, and again, I don't want to just copy and paste it in, because if I copy and paste it in, it'll leave references to the other file. Right? And I don't want to do that because every time I open the file, it'll say, where's the other file? So in this case, copy, paste special values. I'll do the same thing for the balance sheet. This was the Costco balance sheet. I go back to my downloads folder, open up the Nordstrom balance sheet, select the whole balance sheet tab, copy it, come in here, select the whole balance sheet tab in our model, right click, paste special values. And then finally, the cash flow statement. I go back to my JWN cash flow exported file, select all the cash flow data, copy it, come into my Costco model, paste special values, and basically what I've done is I've overwritten all of the data for Costco with the Nordstrom's income statement, balance sheet, cash flow statement. And again, because we're using the standardized format in Bloomberg, it should overwrite it row for row, as long as I start with cell A1. That's why I selected the whole tabs. Questions about what we just did? All right, so continuing on, to reuse the model, I go to my Assumptions tab, and I want to start updating my assumptions. First, last reported year. Easy to check on the balance sheet for Nordstrom's. It was 2013, so that one's good. Operating cash is a percentage of revenue. That's 2% is 1 week of cash, and I think we're going to leave that 1 week of cash alone for most firms this semester that we value, unless we think that they need more operating cash. They're probably not going to need less than a week of cash. So I'm going to leave that at least at 2%. Okay? So at least 1 week of cash or 2% of revenue is going to be operating cash. Next one is the WACC. Well, I just exported Nordstrom's WACC. 8.5% was the current WACC. So again, I come into the WACC and I type in 8.5. The continuing value fields are going to be based on the 2024 numbers, so I'm going to leave those alone. The price to book ratio of long-term investments, I'm going to leave that alone as a starting assumption. Shares outstanding. Nordstrom shares outstanding can be found on the DES screen. On the DES screen, shares out, 194.9 million. So 194.9. Next, forward sales. That was off of the EEO screen. So I'm going to go to the earnings estimate overview screen and put in the forward sales for Nordstrom's first year. And you can see it says ACT is actual, EST is estimate. This is forward year sales 1, forward year sales 2. So 2014 fiscal year, 12,573. Forward year 2, 13,629. Could change between the time we do the export and the other one, but technically, yes, it could be there. Because I had exported this data last week, and I don't know if it's been updated, so I'm just using the freshest data. It probably hasn't changed all that much, but you're right, we could use that. Because the forward data, what he's referring to is on the income statement tab. They give you the forward data. Matter of fact, for 2014, 12,573, which right now still matches, I believe, 12,573. But again, week has passed, it could change. It just hadn't in this example. So I exported this last week. All right, versus today. For the operating income, again, back to our EEO screen. Operating profit for 2014 was $13.38. And operating profit for 2015 was $14.64. Now, this is just a quirk of the Bloomberg data. But if you go back to the balance sheet in Bloomberg, this is their standardized format for the balance sheet. There's the assets. There's the liabilities and equity. And below the liabilities and equity is something which they call the reference items section of the balance sheet. The reference items section of the balance sheet comes from the footnotes. Okay? So basically there's an analyst who scurries through the footnotes of the 10Ks and the 10Qs and enters in the data from the footnotes. Now, not every company has the same data in their footnotes of their financial reports. And the analysts don't always put the footnotes in the same rows. So the one challenge with the data, standardized data format, is everything above reference items to row 43 always comes out in that format. Everything in the reference item section is inconsistent in terms of the rows, whether it shows up at all. So the reason why that's important is in our assumptions tab, and I didn't really mention this when we were building the model last week, but there's two reference items section items called goodwill and pension obligations that aren't always in the same row, and we need them in our model. So the way I've set it up is that we're going to have to just copy and paste that data into the assumptions tab so that our model doesn't know that the reference items change, but our model knows that row 18 and 19 of the assumptions tab will always be the same. So our model is using goodwill and pension on the balance sheet from these two line items for historical data. So what I'm going to do is I'm going to go into the Data BS tab. I'm going to go to Goodwill. I'm going to select all the historical goodwill. I'm going to copy it. I'm going to go to my Assumptions tab, Paste Special Values. So there's the goodwill for Nordstrom for the historical years. And I'm pretty much, like I said, just kind of copy and paste in the historical goodwill. And then for pension obligations, do the same thing. I'm going to take their pensions, copy, pay special values their historical pensions. Okay, everybody see what I just did? Questions about what I just did?
What was the pension?
It is called pension obligations. It would have been row 50. And again, copy paste special values. And I'm just saying, unfortunately, for some companies, like for example, for Costco, let me save this, and I'm going to open up the Costco model. But just as an example, if I go back to Costco, they were 0, and Goodwill was on row 67, and on Nordstrom's, Goodwill's on row 65. See, that's the problem. So the Costco had both pension and Goodwill in their reference items, but the problem is it's not in the same place. So that's why we have to make this intermediate step to always put in the same place. Otherwise, our model gets broken every time we import a new company.
How often did Bloomberg change the field IDs?
Sadly, every now and then. Not too often, because the professionals get really pissed off at them when they do, because they build a lot of their models, so they kind of give you advance warning, but from time to time they will. They'll make changes, but then they'll kind of try and give you advance notice. Because again, this database goes back to the 80s, and they have generally tried to keep it consistent over time. Where it really gets icky, for lack of a better word, is with international companies. Because the original database was mostly US companies, and they've expanded to international financial accounting. That's really where their standardized templates for international companies are actually different than the standardized templates for US companies. So if we were doing a company like Rio Tinto, we'd have to remap our model because the international template is different. And unfortunately, they're not consistent with their international templates. So by country, it's almost different. By industry, it's almost different. So that's why I picked defense and aerospace, because it's a pretty boring industry. It's been around forever. And the templates are very standard. So you don't have to worry about changing the rows, which I unfortunately just happened to my undergrads, because the airline industry has a unique template. And I have my airline industry is one of my undergrad sections. They're all complaining because they have to remap the model. And, it's just extra work. It doesn't take too long. But nonetheless, this is easier if you just copy and paste in as we're doing. So, back to this. Go back to my assumptions. Final assumption that I need to make here is on the ratios. Now remember that the first 2 years of the ratios for growth rate is based on the change in the EEO sales data. Now, I had made some assumptions for Costco into the future. Since I'm reusing the Costco model, those hard-coded changes are still in here. So one of the things that you can be very careful about is if you don't undo the hard-coded changes you've made in the yellow fields, you can really get some weird share prices. So what I'm going to do is for 2016 sales equals 2015, and copy and paste that out. And I'm going to do the same thing for cost of revenue for 2014 equals the previous year. Copy and paste that out. And finally, tax rate. I'd use the average tax rate for 6 years for Costco, and by eyeballing the tax rates for Nordstrom's, they look extremely consistent. So I think an average of 6 years of the tax rate seems representative for Nordstrom, about 38%. Okay, those are really the three changes that we had made previously to the model. And by the way, when I make those changes, I am somewhere around 78.94 a share. Okay, final step to get it ready to be the baseline. I need to go back to my assumptions, and I need to match the operating income in the model with the consensus. So in this case, the model has a higher operating income than the consensus. So I'm going to have to increase my cost of goods sold by 43 basis points. So cost of revenue plus 0.0043. And then by another 10 basis points, plus 0.0010. So now I have matched, oh, wrong way, subtract. Now I have matched all of the assumptions in both models. Right? And I'm ready to start doing my as-is valuation. Right? Except I'm going to throw one more caveat at you. And this didn't really occur with Costco, but this does occur with Nordstrom. If you go back to the McKinsey example in the book, where McKinsey talked about their valuation for Home Depot, one of the things that McKinsey did when they did their Home Depot valuation is they had subtracted out the leases for Home Depot. Because they said to get from enterprise value to book value of equity, they had to pay off the debt and they had to pay off the leases. Well, Costco didn't have any leases, and since we were just building the model, I didn't want to make it more complex than it needed to be. But if we look here at the balance sheet, Nordstrom has some operating leases. Matter of fact, they got about $1.7 billion worth of operating leases. And given that they have 170 million shares, that's about $10 a share worth of operating leases. So we don't want to distort the value of our valuation because we overlook the fact that they got about a $1.6 billion operating lease obligation. Everybody see that? Now, here's where we're going to kind of take a rough approximation to this. In an ideal world, because the lease is both interest and principal combined in a lease payment, what we really want is the present value of the leases, right? And what the data that Bloomberg is reporting is the current value of the future operating leases, which is not necessarily the present value of the operating leases, right? So the number here is probably a little higher than the actual present value, but at least it's an approximation of some value for the operating lease as a liability. And it is a present value number because it's today's number. But if I took the present value of the actual future leases at some discount rate, I'd probably get a slightly lower number than this. But I at least got to recognize for our valuation that I need to subtract the operating leases. So ideally, I go through the 10K, I figure it out year by year, I present value them, and that's the number I use. Shortcut for our purposes in this class is we're going to use the 1619. So what I'm going to do is I'm going to go to my DCF valuation. And when I calculated common equity value, I took the enterprise value and I subtracted all these items from TFI. The other one that I'm going to subtract is the operating leases. And I'm going to put, so I remember this, the operating leases on my assumption screen. I'm going to make that yellow because that's something that I'm going to change. And for now, I'm going to refer to just the most recent value because I care about the current operating leases. I don't care about the historical ones, which is the 1619. So I got $1,619,000 of operating lease obligations. Okay. Everybody see that? So here's what I'm going to do on my DCF valuation. I'm going to get common equity value, I'm going to refer to that operating, spell this right, operating leases. I'm going to take in my DCF valuation the operating leases, and when I subtract all these items from enterprise value, I'm also going to subtract the operating leases so that I get essentially a lower share price to take into account that operating lease value. And I'm going to do the same thing on my economic profit valuation. So on my economic profit valuation, I'm going to use the same operating lease value. And the common equity value, I'm going to make sure that I'm subtracting the operating lease value from that. So I get the same 61,701 share price in both tabs. Questions about what we just did there? So again, what we want to do is we calculate the equity value. We want to pay off all of the known liabilities. And in this case, operating leases are off balance sheet. So the TFI took care of all the liabilities that were on the balance sheet, and this is the off balance sheet lease liability. We pay off those, we're left with the equity value, because the shareholders get what's left after everybody else has been paid. So in a cash value, we're down to $67 a share. This is what we called the baseline valuation, and we're now ready to value Nordstrom's to the as-is share price. Okay. Now for the as-is, today, if I go back to the DES screen, Nordstrom was trading at a share price of $62.55. Right? That is their share price today. And I am at 67.01.
Can you jump over to your ratios tab for a second?
Questions about the ratios or no?
No, we wanted to make sure my data was right.
Well, the first 2 years, if you remember, I'm leaving alone because we solved based on the estimates from the analysts. So starting in year 2016, I just equaled 2015 and carried it across. And then for 2014, I equaled, for cost of revenue, 2013, carried it across, and then I just adjusted 2014 and 2015 to match the analyst's assumptions for operating profit by adjusting cost of revenue to be the match. And then for tax rate, I left the tax rate alone because the 6-year tax rate average seems pretty reasonable as a tax rate going forward for Nordstrom. Right. But as I said, our step here is we're going to do 2 valuations. So valuation number 1 is as is. So I want to come up with a share price for Nordstrom's that's within $1, is what I usually think of as reasonable, of their current share price. And as I said, right now, their share price today, they closed at $62.55 a share. So I want to pretty much come within $1 of $62.50 a share, $62.55, plus or minus $1. Now, as we talked about before, to keep it simple, there's 3 things I want to change. 1 is tax rate. I think I have a reasonable tax rate, so I don't think they're going to pay a lower tax rate. 2 is revenue growth. 3 is the sort of operating profit, operating margin. Now, for my revenue growth rate, one of the things that I want to do, and I can get this off of smithapps.rhsmith.umd.edu. If I log into Smith Apps and I go to the Finance tab, one of the items on the Finance tab is the IBIS World Report. And if I launch the IBIS World Report and give me a second to launch it because we all go at the same time and then we're going to have some problems. All right, so I launched the IBIS World Report. I type in Nordstrom, do a search for them, and they're in, we'll call them department stores in the U.S. And if I look at key statistics, this is the industry growth rate for department stores. So for the next 5 years, 0.9%, negative 2%, 0.3%, 2%, and 4%. That's the industry growth rate that IBIS expecting for department stores. Now, if I look at Nordstrom, the analysts are expecting Nordstrom to grow at 3.5% and then 8%. Basically much faster than the rest of the industry, suggesting some level of competitive advantage because Nordstrom is growing much faster than the rest of the industry. They must be doing something right. So in this case, I think that Nordstrom is probably going to grow faster than the industry, but what I see about the industry growth rate is that, which one is it? Here we go. That the industry is not expected to grow very much in the next couple of years. So if I had to think about Nordstrom's growth rate and why they're probably trading closer to $62.50 a share, is the market probably doesn't expect them to grow at 8% a year going forward, given that the industry is slowing down a little. So what if they grow at, I don't know, 6.5% or 7%? Well, 7.5% gets me at 62.80, and their share price today was 62.55. So one way that I could get to 62.55 is I could get them growing at about 7.5% at current margins. Now, if I look at their operating income, their kind of pre-tax margin, with the one exception of 2008 when it was approaching 13%, and 2009-10 in the recession when it fell to 9 and 9.7, the last 3 years, their operating margins have been in a relatively tight band of 11.5, 11.5, and 11.1. And if you really look at what the market is saying, 10.6 and 10.7 for the next 2 years, the worst they've ever done is around 9 in the last 6 years. You could make a case for slightly higher growth. So let me put this growth rate back up at 8% and slightly lower margins, where instead of 58, I say 58.2. So I could say maybe they grow a little faster and they have slightly lower margins, but you'll notice the margins don't have to change more than about 10 or 20 basis points to just a few dollars a share. So Nordstrom is very sensitive to margins. That's something we can quickly see in our model, that whatever their margins are is going to have a big impact on their stock price. And the growth rate matters less, but somewhere in the 7 to 8% growth rate longer term, think the next 8 years, 8 to 10 years, and somewhere in about similar margins is probably what the market is thinking if they're at 60, were they 60.55 or 62?
62.55.
62.55, to be somewhere around the share price that they are today. So I don't know exactly which of the two it is, but I have a general idea of the range. So that's what I would be saying for my as is, right? So notice that I'm speaking my assumptions along the way. Assumption number one, the industry is growing at this rate based on the expectation of the analysts. It's the IBIS World Report. And Nordstrom is growing faster. But I think that Nordstrom's growth will slow because the industry is slowing. I don't think they're going to go to the industry level of growth, but I do think that Nordstrom is probably going to have trouble maintaining its current growth rate for the next 8 to 10 years, because I do assume that there's some regression to the mean, law of large numbers, and the fact that they're going into an industry that is growing slower. So it's going to start tampering down their growth a little bit, right? I could also say, you know what, I think the market's going to get a little bit more competitive, so maybe I don't grow them as, I grow them faster, or I have lower margins. I personally think, if I had to choose between the two, that this is probably the more likely scenario, that a little bit lower growth and similar margins. That's probably what the market is thinking today. Some combination of the two. And again, we can't necessarily be exactly right, but we're getting an idea of what the as-is is. Okay? So this is my as-is valuation from Nordstrom. Now, the other way that I'm going to look at the valuation is I'm going to save this. And I'm going to call this the as-is. So I think I have a good understanding of what the market is thinking when they value Nordstrom's at about the price that they're valuing them today. Now I want to do what's called the final valuation. Now I want to decide, do I agree with these assumptions? Because as my assumptions change, the stock price that Nordstrom will be valued at will change. And now I'm going to put in my point of view. Right? So when you do the as is, you're trying to figure out what the institutional investor point of view is. Right? And I say institutional investor because if I go back to Bloomberg, HDS is holders, and we can see that 88% of the company are owned by these 18 institutions. So I'm just telling you that Nordstrom stock price is going to be driven by a few institutions. Right? So that's why I said we're kind of trying to figure out what is the wisdom of those institutions when they're pricing Nordstrom today. And somewhere around this level of growth and this level of margin at this cost of capital seems to give us a fair price for Nordstrom stock. Right? That's where we backed out their point of view. And again, just to reiterate, it's not whether I agree with their point of view. I'm just trying to understand what their point of view had to be to justify the price. Because we got a price, we're trying to figure out what assumptions get us to that price. Now, when I jump to the final valuation, now I put in my point of view, because maybe I don't agree with these assumptions. And now I actually put in my assumption for Nordstrom's. So do I agree with the growth rate? Do I agree with the margins? So, what do you think? What should we do? Yes?
I would think that in the long run, you would lower the growth rate some because if they're able to sustain such a high growth rate, somebody else is going to come into that market as well.
So give me, what do you think it's going to go down to?
I would have said somewhere around the 3-4 range. I would probably say 6.
All right, starting when? Approximately. 3 years out, 5 years out?
2020.
So by 2020, you'd put it closer to 6. Well, what you've really done is you've put it closer to a $60 share price. So as their growth slows, what about their margins? What's your point of view on margins? Stay the same? Do they compress?
I would think margins would contract as well because they're competing with somebody else.
Okay. So the kind of super premium segment that they're in, more people are going after, gets a little bit more competitive. People have online alternatives. They start buying clothing and the service doesn't seem to give as much of an advantage. So maybe their margins compress a little bit. So what if they grow at 6% and we've seen that their margins have been as low historically, if we look at the pre-tax, around 9%, and right now they're at 10. So what if they go down to around 9.7 again, or they lose about a point of margin? So instead of 58, this gets down to 57. So that their operating margin, this goes to 59. So their operating margin goes back to 9.7, which is where it was a few years ago. Well, then they're at a $51 share price. So that point of view, which says mid-single-digit growth and an operating margin closer to where they were in 2010, sell. Get out. Because right now I have something that's worth 51 and I own it and it's trading at 62. This is where the shorts would come in. If the shorts thought that the market was going to quickly determine that, they would short it. If not, I would just avoid it. If I thought it was a while before the market figures out, I don't short it because it's expensive to short in the short run. So therefore, I just sell. I just avoid. But I put a sell rating on this. So our buy, sell, hold is a representation of trading range. So if our final value is within 10% of the current stock price, plus or minus 10%, we're going to say that's a trading range and that's a hold. If our final stock price is above 10%, fair value of the current stock price, then we're going to call that a buy. And if our final stock price is lower than 10% of the current stock price, then we're going to call that a sell. So at 51.53, given a $62 stock price, Nordstrom is a clear sell. So that would be my buy, sell, hold analysis on Nordstrom. So file, save as, JWN, sell. Now, undo, 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 and I'm back to where I was with the as is. Does anybody have a different point of view? Does anybody have a more optimistic point of view on Nordstrom? Because I'll tell you that in the real world today, ANR is the analyst rankings. And if you look at the analyst rankings, today there are 17 analysts that have a buy rating on Nordstrom, with price targets. Here's a 72, here's a 73, here's a 69, here's a 73. There's a bunch of analysts, and UBS is RBC Capital Markets, Goldman Sachs. These are some serious firms that have a very optimistic point of view on Nordstrom's. So,
Where those guys do all their shopping?
true, there could be some sort of bias there. But here's the thing. If Nordstrom is able to get back, let's look back to their operating margin, closer to 11 to 11.5%. So again, if this starts going back to 11.5% sooner, so let's call this 57.5, and this goes to 57. So I'm at 11.7% margins with, again, about a 7.5% growth rate. Then I agree with the guy from Goldman Sachs. And now I'm a Nordstrom buy. We're predicting the future. We don't necessarily know which one is right. And so when you do your group projects, I can't tell you whether or not I agree with you or disagree with you when you're doing Raytheon and General Dynamics and Northrop Grumman. But process-wise, what I need you to do is I need you to explain your assumptions. So what I really need you to do is when you do your valuations, you're going to do two valuations. You're going to do the as-is, and you're going to call out the assumptions that you think the market is making that gets you to the current share price. What's the price? What did you change? And then you're going to give me your point of view. Do I think that those assumptions should be different? And then what is the final share price? Why do I think they are different? And I should have used some data from my EIC analysis. I should have used my data from my historical analysis because I got historical margins, historical ratios that can help me influence my view of the future. I can look at the analyst reports themselves. I can look at a few analyst reports and see what the analysts are saying. I can look at the analyst recommendations for the buy-sell holds. And that could influence my view of the future. But again, I could also come up with a Nordstrom buy. So that's what you're going to have to do for your group projects. But let's say you're doing this in the real world. Which one's right? What do you feel?
Depends.
I know, but what's your feel? You got to come up with a point of view. So you've established kind of a high and a low range, or at least some range. Which one do you feel you most likely support? Do you think they're fairly valued today? Do you think now's the time to buy? Do you think now's the time to sell? And by the way, if we look at Nordstrom, GP is graph price. Here's the last 5 years. Their stock price has gone from around $10 a share to $62. That's a pretty good run-up. I don't think that's going to happen again in the next 5 years. I don't think they're going to go up by a factor of 6 from 60 to 360.
Can you go out to 10 years so we can see what happened before?
You want to go 10 years, 2003. Here's 10 years. So they went from 10 to 50 to 10 to 60. Yes?
What's Nordstrom's beta?
A little over 1. 5 years. It's been 1.5. So 1 in the last 2 years, 1.5 in the last 5 years. And we want to use 5-year betas when we do our EICs.
So wouldn't another point of view be, or wouldn't a possible one be, forgetting the model for a second, if you think the overall economy is going to do well over the next 5 years, then again, Nordstrom will probably be good.
That's right. But if the economy has an eventual dip back towards recession,
Yeah.
then Nordstrom is probably going to be hit. So is it reasonable to have 7.5% growth rate for the next decade? So that's what we have to decide. So when you put it that way, does that influence your judgment on what you think it is? Buy, sell, hold? You like the buys? You're still on the buy side?
Yeah, because just like all the other analysts who don't know what they're doing in Bloomberg, they just follow the
Okay, so you're just gonna say, you know what? I think RBC, UBS, and Goldman know what they're doing, so I'm just gonna follow them.
Yeah.
Okay, that'll probably keep you employed for a couple years. Anybody have a different point of view now? See, I think that point about beta and what's happened to their historical stock price in the dip leads me to believe that, Nordstrom probably has more downside risk than upside. And given the two, I'd probably be in more the hold sell side. So, I'll keep shopping at Nordstrom, but I wouldn't advocate buying their stock at this price because I see more downside risk to their stock price than upside. Because a lot of the upside has been priced in. They still have to have some pretty aggressive growth, and they got to maintain some pretty aggressive margins into the future in order to justify this price. And if we hit a soft patch in the economy and they have a high beta, then their margins and growth rate could slow relatively dramatically, as it did in 2009, 2010. There's the example of the beta right there. And so you see a little hiccup in their growth rate, and that could cause the painful adjustment in their stock price in the short run, as they've seen before. So again, I like to think of this as, the analysts have blinders past 2 years. That's actually one of the reasons why I use 2 years worth of data. But it's almost hard to see in the analyst world, oh yeah, Nordstrom is just growing at 7% as far as the eye can see, and Nordstrom's going to make these great margins until, oh no, there's a recession. How could we not have thought of this before? And then suddenly they adjust. So, in the short run, sure, Nordstrom's is probably a good momentum stock because people have good feelings about the economy. But when the feelings start tempering down and then people's view of that growth starts to slow, or they see actual slower growth and slower margins, they got to hit all this upside to justify their current price. So I'm just saying that this is probably the true story of a lot of stocks. If you look at the stock market today, where we're at a very high, record-setting Dow, record-setting NASDAQ, close to the record S&P or at the record S&P, this is all because all of the expectations of all that growth are built in, and people aren't expecting rough patches going forward. And an example of a rough patch is what happens if interest rates rise, and what happens if the cost of capital spikes on them. So, for example, instead of 8.5%,
Interest rates weren't going to rise.
we go to 9. Well, then suddenly that $70-something stock price turns into a $62 stock price. You're saying interest rates are not going to rise?
Yeah, that's what the bank keeps telling me.
Well, again, difference is a point of view. But there's our buy, sell, hold. All right, how do we know we're right? We don't. But here's the last thing we're going to do to help us think we're right. What we're going to do is we're going to come here to the ROIC chart, and we're going to redo the ROIC chart. So I'm going to delete this ROIC chart, and I'm going to add a new ROIC chart. And I'm going to base it on end of year ROIC, okay, as opposed to beginning of year ROIC, because I'm no longer interested in matching the model. I want to look at the actual ROICs based on end of year data. So what I'm going to do is I'm going to regraph the ROIC data historically and all the way into the future. So I now have, there's 11 plus 6, I have 17 years worth of ROIC, I believe, on here. So insert sheet, chart sheet, make this a line chart, and this is a forecast. Select my data, and I'm going to change the x-axis labels to match the years. From 2009 through 2024. Call this my ROIC chart. Rename my tab ROIC chart. This is a forecast for ROIC historically and in the future. And by the way, this is at Nordstrom, $72 a share. This was the buy scenario. What would we expect that should happen to this ROIC chart over time? What should happen? Yeah, it should probably start regressing to the mean. This is what is often called a hockey stick. There's the stick. Where it's just going up and up and up into the future. So we're saying the future out years, when the industry is maturing, they're going to be doing much better than they are today in an ROIC perspective. I'm not saying that's not possible, but that's not what we would expect for most industries and most companies. By the way, let me go back to my hold scenario. And in the hold scenario, we go to more consistent margins where they are today. Notice that in the hold scenario, or I will call this my hold, basically the as is, notice that the ROIC stays relatively flat in the out years. To me, this looks like a more realistic scenario. As a matter of fact, the more realistic scenario is for the ROIC to start trending down, which is my sell scenario. So given the ROIC chart, I would say that the hold already starts to look aggressive because they have to maintain an 18% ROIC pretty much perpetually and maintain their competitive advantage in an ever-toughening industry to basically and maintain that level forever to justify their current stock price and not regress to the mean, which I think is unlikely. So that's the final part of your valuations. You're going to have to give me the ROIC chart after you do your final valuation. You have to put that in your presentations. You have to put that in your papers. And then you're going to have to justify it. You got to tell me that this is why you think that this is realistic. So you can have this. Here is the buy. But you got to justify. And I'm saying if you took EIC and you applied it to this chart, then you got to tell me why this is either a much better industry going forward, better five forces, or you got to tell me why they have this amazing competitive advantage that's just going to continue forever. Because that's the only way you justify this level of ROIC improving in the future. Some combination of those two. And I think you're going to have a hard time doing that. So that's why I'm biased towards the holds or the sells. I think Nordstrom is fairly priced. In fact, I think Nordstrom is optimistically priced. So I'm on the hold or the sell side. I don't think that there's that much reason to buy Nordstroms at this price. I'm not saying it can't go up because people are optimists, but on a fair value standpoint, I think we're getting to the point where they are completely fairly valued, and all that upside has already been priced in. Okay, questions? Yes.
Do you have a perspective on when you think interest rates might rise, like possibly next year anytime?
Given that our government is manipulating them, I have none. I mean, I assume that they're going to rise, but like I said, we're playing games with them. But, you know, I would have thought that they would be much higher than they are today. But, you know, this woman Yellen, who seems to be willing to print money forever. So as long as you have sort of her in there with Obama asking her to print money, I worry that interest rates are going to stay artificially low. But that's what I said, who knows? But that's at least the perspective the market is using right now. All right. Okay. So here's what I want to do. I'm going to save this. I'm going to put this file online. I'm going to ask you to take a quick break. And when you get back, I'm going to ask you guys to do, since we're kind of going on our retail theme, Macy's. In honor of the Macy's Thanksgiving Day Parade, which is coming up on Thursday. I'm going to put the data for Macy's into a folder within the next 5 minutes. I'd like you to come back and basically do an as-is and final valuation of Macy's and take about 30 minutes to do it. So about 20 till we will talk about Macy's. Okay? So that is your next exercise.